We are.
Yeah.
Okay, so, hey. I want to thank everybody for coming out to the happy hour. There's no sound. This is just recording for posterity. So yes, we're recording this video because believe it, there are a couple hundred people that don't live here that actually asked if they could listen in, and we didn't want to Facebook Live it because I don't know how the internet is here down here. So anyway, these guys are awesome. Joseph has kind of been working with us for, I don't know, 5 or 6 years now, maybe even longer.
Yeah.
His firm is our CPA firm, my personal CPA firm, and then all of our businesses, and provides us counseling on software, on all of our real estate stuff, the law firm, possibly some farming in Oklahoma that you're supposed to get back to me on.
We're good.
We're good?
We're good.
So he also represents us on our medical green farming that we started in Oklahoma.
Okay.
And
share it with everybody, but that's
no, I didn't say what it was. It's just plants. Only in Oklahoma. We're a couple of my partners out there. They're hiding on that deal, but and also is involved on a helium venture that I'm invested in too. So they're a very well-rounded CPA firm. Most of you guys pretty much know what we're talking about today, or what they're talking about. Accelerated depreciation expense, kind of what you should and shouldn't do with respect to allocation. There's some interesting memos that are going around, or a memo that's going around that's created some confusion, and there's a lot of confusion actually on Facebook about what you can or can't do, or what you should or shouldn't do. This is not legal advice. These guys will probably say they don't represent any of you individually, so this is more informational, but it makes sense. What they're going to tell you, I've seen the slideshows, the slide presentation. They're going to tell you what I've independently confirmed with 3 other CPA firms that I'm not going to use, but I wanted to get some independent confirmation. So I'm very excited that they were willing to send 3 guys. One's an Aggie, but we're not going to say which one is an Aggie. At all. Yeah, so you've got
two.
I've known him forever, and I can't do anything about it. Yeah. But anyway, they're all good guys. And real quick, Joseph is a new dad for the 3rd time.
Yeah.
Another girl?
Another girl.
Another girl.
3rd girl.
3rd girl.
Yeah.
Anybody got advice for him that was different than what I told him?
Stop. That's
there
good.
you
That's
go.
good.
There you go. Luckily, his wife's not here. So anyway, guys, we're going to let them do the presentation. Some of you guys may have questions. I'd really appreciate if you could leave the questions till the end. That way they can get through the presentation. It's only about 20 slides. I think it's pretty self-explanatory, but you're going to have some questions. Some of you I know already have questions. So let's save the questions till the end, and when we do, you can come up and use the microphone so that at least we can record. And if anybody can't hear the question, I'm pretty loud. I can re-ask the question. So you guys are mic'd up. You can use this if you'd like.
I'm going to grab his when I talk.
Yeah,
okay.
we have sections.
Okay, perfect. So I'm going to let them introduce themselves and go for it.
All right, thanks, Merrill. Appreciate it. I'm an Aggie as well, so I saw a gig over there, so that's good. Yeah. So just real quickly, just introduce myself. My name is Joseph Hildebrand. I'm a tax partner at Saville. I've been there for 11 years, and I'll let these guys quickly introduce themselves as well.
I'm Luke. I'm a tax manager. I've been there 6 years.
I'm Ben. I'm a tax senior manager. I've been at Saville for 6 years, and I went to UGA, a member of the original SEC.
Okay, thank you. So just a real quick kind of background about our firm before we kind of get going. So our firm is Saville Dodgen. Yeah, this is all of our partners here, and they're pretty mugs. But we're a full-service CPA firm located in downtown Dallas. We've been serving the Dallas Metroplex for about 55 years. Like I said, we're a full-service accounting firm, so we've got tax, audit, client accounting services. Hey, George. And IT services, and so we kind of run the gamut of services as far as CPA firms. From a kind of an industry perspective, we kind of work on industries you'd expect a Dallas CPA firm to work with. And so one of our largest industries is real estate. In fact, the three of us work within and lead our real estate niche. And so we spend quite a bit of time in the real estate area specifically, and try to stay up on TPE and tax bill changes and things like that along the way. And so, not that we're going to claim to know every single thing, and I'm interested to hear what kind of questions and things you guys have, but we think we have spent a lot of time researching these items and dealing with these items, especially recently. So, today what we're going to do, and Merrill kind of took my thunder a little bit, but we want to just kind of start and talk to you about really what is a cost segregation study. Two, we want to talk about partnership allocations and how that goes. From there, that's kind of what we came here to talk about. That's kind of what Merrill asked us to speak about. And so I think we'll kind of stop there and open for questions, and we'll just see how that goes and how much time we have, because from there we also have a few slides just about the tax bill, because that's still pretty new. And we've really only gone through one filing season on the new tax bill and how those things work. And so we just added just a few things in there that we think is still very applicable to real estate and managers or syndicators specifically. So if we get there, great. If not, we'll pass out cards and you can shoot us an email or something. So, Ben, you go to the next slide. Well, back up. Did we miss the circular?
Yes.
Yes, circular 230, as Merrill mentioned, we cannot rely on anything we're about to say at all. And it is not advice at all. Find your own CPA, but we're also open for business too. So anyways, I'll turn it over to Ben as we jump into the cost segregation part.
Thank you, Joseph. All right, so first, just to get a feel for the room, how many in the room have dealt with, been involved with, owned a property or partially or managed one that has gone through a cost segregation study? Okay. Good few. So I apologize for any people here that this is rudimentary information, but we're going to go kind of on the basics of what a cost seg is and talk about the depreciation and everything as well. So what is a cost segregation study? Most people know a cost segregation study in the context of it being a tax-saving mechanism and maybe not much else. But a cost segregation study is just that. It's a study. It's a report. Generally, the process is an engineer will go out and inspect a property. They'll look at all the different components of the building, and then they send their findings to an analyst who kind of puts together this report. And the report, its main job is to break the building down into its components for IRS purposes. So the IRS says that when you buy a building, you actually, without a cost segregation study, have to just show it on your tax return as one building. There's no breaking down of different parts of the building unless there is one of these studies done. And you may ask, well, why is that important? Because of accelerated depreciation. A building in itself, for IRS purposes, if it's non-residential real estate, so retail, hotels, stuff like that, you depreciate it over 39 years, so not very advantageous. A building like this, residential real estate, is 27.5, a little bit better, but still not much. A cost segregation study allows you to break it further down into usually 5 and 15-year, sometimes 7-year property. So obviously that shortens the time span of depreciation, increases the deduction every year that you would get for IRS purposes. But the real kicker, especially with the new tax bill that passed, is bonus depreciation. So right now, and until 2023, I believe, you're eligible to take a full write-off first year of those 5 and 7 and 15-year breakouts that you get from a cost segregation study. So 1 year, you write the whole thing off. That's bonus depreciation. It sunsets in 2026 fully, and between 2023 and 2026, it kind of stair steps down from 100 to 0. So that's obviously a big incentive to get one of these studies done if you can accelerate your depreciation on the front end. To kind of put this into perspective, we're going to go through a very simple example. So this is an example of first of all, a $10 million commercial building with no cost segregation. The first thing a lot of people don't think about when they're getting a cost segregation study is, first of all, you have to break the land out. It's not just a building. There's almost always land underneath the building, right? So generally, 20% is kind of a baseline. Louder? Okay, I'll try. So 20% is generally the baseline. There's different allocations you can do, but for this example, we're using 20%. And so that would leave the building at $8 million valuation. So this is a commercial building, non-residential. We would depreciate that over 39 years. How does everyone feel about a $200,000 deduction on their $10 million outlay? About like that, right? Yeah, not great. So what does a cost seg do for you? Same example, $10 million building. Land is going to stay the same. The cost seg's not going to help you with that piece. But you would break from the building, in this example, this is kind of a industry standard example. It's neither aggressive nor the worst case scenario. You would break out 15-year property, in this case land improvements, of around $800,000, and furniture and fixtures of $400,000, giving you bonus depreciation and regular depreciation on top of it of $1.4 million basically. So huge increase in your first year deduction. So obviously, feel better about that, right? So how does that translate to tax savings? Because that's obviously what we're going after here, right? This is where the caveats start to come in. Tax savings are always a touchy subject because they're not the same for every single person who maybe is an investor in this project. In this example, we're assuming that they're going to be saving taxes at the top tax rate. So they're subject to the highest tax rate possible, which means they're a high income earner. And the kicker, the biggest kicker is full deductibility of losses. Luke's going to talk a lot more about when losses are deductible and when they're not in the next section. But this example assumes both of these things, so it's best case scenario. $430,000 tax savings in year one, getting a cost segregation study. We're going to go into how much a study costs in a little bit, but it's not nearly that much. So you can, obviously you can see how this is an easy sell to investors in a deal. Now, one of the criticisms you get of cost segregation studies when you talk about them is it's really not a tax savings, it's just a tax deferral. And what people mean by that is, well, you're taking depreciation, but there's this concept called recapture. When you sell an asset for IRS purposes, if you sell it for a gain, you are potentially subject to recapturing the depreciation you've taken as ordinary income. And in that case, if that did happen, that would just be a tax deferral. You're saving tax in one year, and in future years, you're paying income tax on the recapture of the depreciation. So what's really key when you do a cost segregation study is that you think about the exit as well. So there's always a kind of a give and take analysis you want to do before you jump in on one of these studies. Make sure it makes sense. But you also need to be thinking about with your tax advisor, how is this sale going to occur on the back end? So, oh, sorry, wrong way. Allocation of the value of the asset components is going to be key when you sell the asset. If you are able to justify an allocation where the component that you've depreciated 100% doesn't have a lot of value, then you're not going to have a lot of recapture. So in this case, if you valued the land improvements at only maybe $200,000, you've taken them down to zero. You have a little bit of recapture, $200,000, but you're not recapturing that full $800,000. So you've got a true tax savings there of $600,000 of ordinary deductions. And the reason that works is because when you sell, you're usually selling it at capital gains tax rates, which are 15 to 17% lower than ordinary income tax rates. So that's where the true tax savings comes in. Any questions? No, that's a quick summary of cost segregation studies.
Is there any way you guys could just move a little bit or switch around?
I'm sorry.
I can't see the screen.
Luke, you're in the way.
Any questions on that? Yes.
Is there a max percentage for the recapture?
A max percentage of the recapture? You only have to recapture potentially the depreciation you've taken, but there is no max as far as how much of that you have to. You can recapture the full amount, depending on the allocation on the sale. The recapture happens usually at ordinary income. That's why you want to avoid it. Yeah. All right. So just to go into typical breakouts by building type, this would be the breakout of 5 and 7 and 15-year property that you get the bonus depreciation on. For apartment buildings, 8 to 25% of the cost. Office, 10 to 20. Restaurants, 10 to 30. Hotels, 12 to 25. Retail, 10 to 20. Warehouses, 6 to 18. And manufacturing and processing, 8 to 20. The reason why these are so broad is, every building is unique. In a building like this, for instance, an apartment building, you may have a lot of common area with a lot of amenities, or you may have one that's pretty bare bones. That's why you're going to see that range. And then we talked about going to the typical costs. So one thing here is there's a lot of different types of groups who do these studies. We have a gentleman here named Dave Ramsey. Not that Dave Ramsey, but this Dave Ramsey, whose group just does cost segregation studies. We do some in-house as a CPA firm. Some other CPA firms do them as well. So these are the costs of our studies, but doesn't necessarily represent everybody who does these studies. And you can see kind of the ranges here. Again, the ranges are going to be dependent on building type, size, site area, number of tenants. There's a lot of different, buildings are very unique, and so this is we always do fee estimates for these studies on the front end, getting an idea of these factors. That's it.
Okay, so
Here, let me give you this.
all right. So, as y'all know, partnerships don't actually pay tax. So I'm going to talk about the allocation of either the losses or the income among all the members in the partnership on their K-1s. Like I said a second ago, partnerships don't pay tax, so all that operating activity gets passed down through a K-1 that gets given out to all the members or the managers. Generally speaking, the
Speak up.
the P&L activity,
Just
so
shout,
the
Luke.
operating activity is allocated out based off of who financed the operating activity. So if, for example, if the members contributed capital, or maybe the manager didn't, they didn't actually finance that operating activity, which then created the losses or the income. Therefore, they're not going to get allocated the losses or the income. So typically, your income or loss allocations follow the cash. If they contributed cash, then they'll get allocated that operating activity. There is a concept of economic risk of loss, meaning who has a risk of loss in the event the property were to go bad, who's going to have to pay back any of the debt or anything like that, and that can allow non-capital partners or members to be allocated losses. However, it is a little more rare, just because a lot of times the managers don't actually have a risk of loss unless they've guaranteed the debt, which a lot of times they don't do. Anyway, do y'all have any questions about that? I'm going to go in further into the economic risk of loss piece. Yeah, so economic risk of loss, the question is who would suffer a loss if the partnership were to dissolve? To determine that from a tax perspective, you would do a constructive liquidation where basically you assume all the assets are sold for their book value, and that book value is then used to pay off the debt. If the debt is greater than the asset value on the books, well then someone has a risk of loss because somebody would need to pay back that debt. Since the managers are non-equity, if the managers did guarantee the debt, or if they have an obligation to pay back any of that excess, then they could show that they have a risk of loss, and then you could use that as a justification for allocating them some of the operating activity, even if maybe they don't have a capital interest. Yeah. Do you have any question about that?
I do.
Okay.
How does that risk of loss play into, say, an apartment syndication where the manager has no personal recourse for the debt, but their name's on the debt? Does that put them in a position to
No, I would say the only way you could trace the risk of loss back to them is if they actually guaranteed the debt with the bank, and the bank has recourse to them.
Recourse loan.
A recourse loan, right?
So
If it
you're
was
saying on a non-recourse loan, there's really no tax benefits to the manager?
right, the only way on a non-recourse loan would be if there's a provision in the partnership agreement that says the manager could have to contribute cash to relieve any of the partnership's debt. So in that case, then it would be, you could look at that piece as being recourse to the manager, even though maybe it's not recourse from the bank's perspective. It's recourse to all the other partners.
Even on recourse loans, they're still guaranteeing the loan. There's still personal guarantee on a non-recourse loan.
Sure.
Bad boy carve-outs.
Yeah, there's all these carve-outs and.
So in those situations, it's the bad boy carve-outs don't necessarily create the economic risk of loss because it's dependent upon, it's dependent upon the action of the manager to create that recourse, right? So it truly is, what we look for when we're doing these is we look for, we look for true guarantees in the loan agreements from the manager.
So just like hypothetically, if there was a deal sponsor that, say, has 10% equity as their sponsor cut, but didn't invest any of their own cash at all, and they're a signer on the loan and all that, would they would get nothing from the accelerated depreciation?
I mean, they would get whatever was allocated for the equity interest they have, but as far as their interest as a manager, I would say no.
The answer is zero.
Yeah.
I kind of brought it up earlier. You guys are asking the right questions because you don't like the answers. That was why I wanted these guys to come here, because it's one thing for the lawyer to say, okay, I've done my research and this is what I found, but I really value these guys because they've represented us in a number of different areas and they're a very well-known firm here in Dallas. But people asking about the bad boy guarantee, the reality is not a single person in here would sign any other guarantee. No one here is going to sign a PG unless they absolutely have to. So the reason they don't want to sign a PG unless they absolutely have to is because they'll be liable and there's economic risk. So the bad boy guarantee is if you commit fraud or you intend to do something wrong. The reality is you guys are all, you have the wool pulled over your heads. You don't need to sign that ever. The bank can come after you whether they have a signed document or not. That's just to scare you and make you think like you have some sort of liability. It's already there. So the big deal on that is, I didn't mean to interrupt you guys, but it's the actual personal guarantee. I don't think there's anybody in here unless they've done a hard money loan has signed a personal guarantee without a bad boy carve-out. And if you have signed a personal guarantee, that weighs into the economic risk.
Right.
Sure.
Sorry, Joseph.
No, you're good.
Yeah, so generally, if you don't stand to lose anything, whether that be capital or having to pay back debt, well, then you can't get an allocation of the loss. You can't receive something if you're not giving anything up for it, is kind of one way to look at it.
So for standard syndicated, so Merrill,
Sorry.
On most of the deals that you see, standard syndications, if you got a deal sponsor that puts money in but has an override, that override piece shouldn't be part of the.
From a legal standpoint, unless you, just jumping in here as a lawyer.
No, you're good.
No,
Go ahead.
you're good.
Go ahead.
And I'm crouched because my back is hurting. But from a legal standpoint, you're absolutely right. And I'm a syndicator. And I don't have any override because I've read through the laws. I've talked to these guys. Some of you may or may not know Wheelwright. I had the opportunity to talk to him at the last mastermind I did with Brad Simrock for about an hour and a half at lunch, and it was a big issue in our mastermind event. And he was adamantly, you cannot take this distribution unless you have put capital into the deal, because he already knows everybody's deals. He knows nobody's signing personal guarantees. But real quick, anybody who's a syndicator in here? You guys all guarantee that 100% of the capital will be returned to the investors if the deal goes bad? Anybody guarantee that? No, because that's economic risk. Anybody sign a personal guarantee that's a syndicator in here right now? No, you didn't, because creates economic risk. We're all doing these deals because we can go borrow, excuse my French, but shitloads of money from a government-backed entity or a CMBS lender, and we have no recourse. You know, the bad boy carve-out, if you're going to commit fraud or commit a crime, of course you're going to be liable. That's not what the IRS intended to do. So I'm not trying to get, I sound like I'm frustrated, but I've been answering these calls since I can say it, you don't have to say it, since a poorly drafted memo came out on November 24th and then was copied and circulated to about 700 people in DFW. Now has gone all over Texas from a CPA that said, if you do 27 things, then yes, you can take the depreciation expense. So nobody read what the 27 things were, but they just started calling their lawyers, and it's not just me, it's Gene, it's Jillian, it's everybody else saying, hey, we need to change our company agreement because we were told that we can take the expense. Well, if you read the 27 things, and we're not all in agreement that the 27 things actually get to that level, but they all involve risk, guarantee, risk, losing money. And I'm just, I don't mean to take over this because you guys are gonna
No,
go
that
back
sounds
in.
good.
Voice is a little louder than you guys. Crowd control. But I mean, I'm not preaching, but you're at your own risk. You're at risk of an audit. You get audited, everybody's going to get audited in the fund, most likely. I can't guarantee that, but if the fund gets audited and people are complaining that they got the wrong distribution or someone's upset about it, you guys need to be talking to your syndicators and get on the same page. One of the questions I did pose to Joseph, I'm going to put him on the spot because there's really no right answer. But so let's say you did do that in 2018 and you realize, you know, I shouldn't have done that. And it could have been, you know, whatever, by accident, you know, can you fix it or can you try to fix it?
Yeah, so the like overall correct answer is yeah, amend your return and fix it, but that's not real world. And most partnership agreements provide for curative allocations where there are mistakes made on an allocation or something to that effect. And so I would just make a curative allocation to get your capital accounts back to where they should be, as opposed to trying to amend returns, which depending on how many partners you are, creates an amended return for all your partners. And they're probably not going to be real happy about that.
Yeah, some of you guys, most people in here do 506Bs. So they're going to be a ton of investors and then up to 35 sophisticated investors. And that doesn't necessarily mean they understand all of the rules and everything. So curative allocation, that basically means you need to true it up in your distributions in 2019. That's not legal advice, that's just a suggestion. And it's the same suggestion that Wheelwright made as well. You know, what you did as a syndicator is incorrect. If you've shown that you've fixed it, you know, if you ever get audited, at least you have a paper trail.
Yeah. Sure.
I don't know. I'm asking you.
No, I mean that's the right thing to do. And you know, we talked about some of the tax bill stuff. One of the tax bill things that came into play is an adjustment on audit procedures for partnerships, whereas the IRS had major problems actually auditing partnerships, and now they have tools in their toolbox to really go after partnerships for various things, and so it is easier for them. The truth is they're undermanned and incompetent as well, so you know.
Right now.
Yeah.
You know, and kind of, it's interesting. So one of the things I mentioned when I first started, like, we meet each year as well with Joseph and talk about all the businesses, all the operations. I scare him with some new operations that I want to do. I did this time. He even told his associate, what was her name?
Katie.
Katie. They were on the ride up there saying, you never know what you're going to get when you go see Merrill's office, so we'll see. And
You delivered.
I delivered. And these guys, so just, you know, so they're also doing the audit on my fund, Axiom Workforce. So, you know, I have nothing to hide, and they will tell me what they like, what they don't like, procedures, blah, blah, blah. I know you guys don't do it. I've done it because I do 506Cs, and it's easier to get larger amounts of money from bigger investors when they know that there's a third party auditing the funds. It makes a big difference. But take advantage of whoever your tax advisors are. They don't just file your tax returns. They're there to provide you advice and planning. And a lot of people probably wouldn't be in this situation. I'm not saying a lot of people are in this situation. Some people wouldn't be in this situation had they just spent a couple hours. It's nothing, and your fund pays for it anyway. But to just get the tax planning you need, just like you do with your lawyer and you talk to them about a deal you're about to get into. These guys are, I won't say as important, but really close as important as your law firm. They charge as much, I can tell you that.
Okay.
I'm just kidding.
No, I like those expectations.
Well, I've met them. You've met them. Let's put it that way. But no, so I can't stress enough, especially syndicators, just be careful. And if you're going to do it, you're going to do it. Make sure going forward, if you intend to take that expense, if you're going to take that expense and you think, hey, I'll just fight it if I ever have to fight it, disclose it in your PPM. Just be transparent, because the worst thing you want is your investors going after you, because then that also brings in the SEC. Because that's also kind of fraudulent representation. If your investors, for example, Dave Ramsey, the Dave Ramsey, but not Dave Ramsey, right here is with Engineered Tax Services. I was going to introduce him towards the end, but he did a quick eval on a property. I put an LOI in today on, and it's about a $10 million plus or minus accelerated depreciation for the first year. With an $11 million capital raise. I'm trying to figure out what do the numbers look like. That's really good, but I would tell the investors going into it, that $10 million is dispersed amongst you guys and me to the extent I might be an investor in the deal. But if it's an 80-20 split or 70-30 split, $3 million is not going to the manager unless the manager put in that pro rata percent. And I don't think, I'm gonna get myself in trouble, I don't think a manager putting $1,000 into the fund justifies getting a 15 or 20%. Am I right? That's probably not adequate consideration to justify the economic risk.
No, they could get a $1,000 loss out of that.
Right. Yeah, that's actually a very good answer.
Yeah.
Anyway, I'm sorry. You guys.
No, you're good, Luke.
It's your show.
Yeah.
Sorry, it was.
Go ahead, Luke.
Okay, this is just a really basic example. So this guy put in all $50,000. He got 100% of the capital. So this $20,000 loss is going to go to him, not this person who put in nothing. Even though she owns 30% of the partnership, he has a risk of loss of 50. She has no risk of loss, so she's not getting anything. He's going to get all of it. This was just, any investor, even if you do get allocated losses, you're still going to have to pass through all the basis hurdles. You need to have tax basis, you need to have at-risk basis, and then if you're passive, then you can only offset other passive income. So I just threw this up here as kind of an extra thing, but so just because people get allocated their loss, that doesn't necessarily mean you get to take it on your 1040. Anyway, that's all for this section.
Yeah, so are there any more questions or things on this part of it? Otherwise, I mean, Meryl, how much time do we have?
When you said if it's passive, you can only count it as passive, can you just repeat that a little more?
Yeah, so if that investor is not a real estate professional, then it's just a passive investment to them, and if they get allocated a passive loss on their K1, they can only take that loss to reduce other passive income on their 1040. They can't let that passive loss drive their taxable income negative or below what it otherwise would have been.
And that's not it's not that they lose the loss forever.
Right, it just rolls forward.
It rolls forward until there's passive income.
How many hours is it? Do they require to be considered a real estate professional?
750.
Yeah, that's the basic answer. It's a lot more complicated than just that, but.
Oil and gas still the same? Oil and gas you can apply.
Oil and gas, you have to be a general partner. You can't have liability protection.
What about helium?
Talk about that later.
Are you claiming more than dollar for dollar? Like, if you invest $100,000, and you have $120,000 loss?
You can. I mean, your tax capital count can go negative through depreciation and everything. And that's what Luke was talking about with debt basis. That qualified non-recourse debt on the building and everything is going to provide that debt basis to go negative.
Is there a quick formula where you can swag depreciation for an upcoming deal before you have your study done?
You can estimate it.
Yeah.
Well, we can estimate it. I mean, you can apply those base percentages that we put up there.
Yeah.
and kind of split the difference if you wanted a real quick and dirty
All
estimate.
of them was used 20% for land. What are the other?
A few
Sure.
slides back, we can circulate the slides,
Okay.
but a few slides back there was a range of percentages for breakouts of different types of real estate. So those are the best kind of back of the napkin estimates. Go ahead.
If I'm a limited partner and I receive the wrong allocation for depreciation,
Is that
what's
what
the
you're asking?
procedure to contest the K1?
What's the procedure to what now?
To contest the K1?
Yes.
Oof.
There's a form to file that takes a position contrary to the K1. You're pretty much asking for attention by filing that, and so I would, you would start with going to the manager and saying, this isn't right, you need to fix this, and go from there, and then you might threaten to file that form and taking a contrary position, but you would really want to make it be worth it. Because when you think about it overall, it's all kind of timing perspective of when you're going to recognize those losses and when you ultimately exit the thing. There is some arbitrage on capital gains and ordinary and things to be considered, but you got to decide if that's a hill you're going to die on.
Careful what you ask for is what he's saying.
Yeah.
Does a curative loss or curative correction or curative allocation occur in the next year, or could you do it at sale?
Well, usually it happens in the next year when
Yeah.
it usually happens to correct the mistake when it's found. You could potentially do it upon the sale, but one of the problems with that would be kind of what Joseph mentioned, matching income and loss types. So if you're going to correct it on the sale year, you're going to be correcting an allocation of ordinary loss with capital gain, which is not.
What about in 2020? I'm just thinking as a sponsor who could be in that situation to have more time to prepare for losing some of the losses we had in 2018. Does that make sense?
Yeah, so the curative allocations are usually outlined in the partnership agreement. So you pretty much, you look at the agreement and you follow the IRS. If you do an allocation contrary to the partnership agreement, that's a red flag for the IRS. So generally, that's going to be laying out in that partnership agreement how it's done. The agreements I've seen where this happens, you usually recapture it the entire amount in that year, or you discover the mistake.
Could you elaborate a little bit about the 750 hour for the tax professional? You said that it depends.
Sure, yeah. So the two main rules are you have to have 750 hours in real estate, and that's a pretty easy test to pass because the definition of in real estate is very broad.
And that's in a year. That's 750 hours in a year. Yeah.
The harder one to get for some people is that it has to be more than half of the total hours you work. So if you have a full-time job, claiming a real estate professional designation is pretty hard because you're not usually working 749 hours in your real job. So those are the two main rules. There's a lot of underlying rules as well, but those are the two main ones.
So I had a question that was sent in to me. I'll comment on what he's about to say. You also have to actively be looking at real estate, actively doing it. Staring at Zillow and maybe driving by an investment you have doesn't count as active. It's a very it's an arbitrary kind of factor, but use common sense. So if you're going to claim you have 750 hours, I mean, you got to be doing due diligence, making offers, doing whatever you would normally be doing to justify that.
Mm-hmm.
So
meaningful participation.
Meaningful participation.
Material participation, yes.
Sure.
Buzzword.
And documentation, right? I mean, that's what I
Well, document everything.
Documentation.
Yeah.
So one of the questions that was asked of me, I had some people email me some questions. So if you have a group of past investors, you might want to answer this one if they don't want to, but not that you don't want to, I just told them what the question was.
No, go ahead.
So if you have a group of passive investors, and let's say 25% of those passive investors have self-directed IRAs, the self-directed IRAs cannot take advantage of the depreciation expense.
Yeah.
So the question is, from a syndicator, can they allocate 100% of depreciation expense to the other 75% passives? Because otherwise it's a waste of the depreciation expense.
So a couple of things, and I think Luke was going to get here eventually too, but when we talk about allocations, the IRS doesn't really say there's revenue, there's expenses, and there's depreciation. You've got these three things that you can send left and right to your investors as you see fit. You've got those things come together and create a net taxable income that gets allocated to your partners. And so, you really don't have a mechanism to say, I'm sending depreciation to this person and not to that person. The other thing is that 704B is really dictates partnership allocations and everything. And there's this concept, and Luke, you correct me if I'm wrong. There's a shifting income concept.
Yeah.
Basically, the IRS doesn't want you to play games with allocations to create economic benefits for people just out of thin air, right? And that's kind of the foundation of this whole problem with the manager and the syndication too. Those managers are typically materially participating real estate professionals. They want that expense. They can take it. And the IRS knows that, and they don't have an economic risk, and so they don't want to allow them to take it, right? And so they want it to really follow where the cash goes. And they don't really care what type of investor it is, whether it's a foundation, a nonprofit, or a tax-exempt entity, or whatever. They want things to stay the same. They don't want you to game the system, or this is their mechanism to stop you from gaming the system.
Answer the question, you shouldn't do that.
Right? That's right.
Correct.
It's always one in the crowd. Yes, sir.
I'll keep it simple so you can deal with it.
Thank you.
As a passive investor, what's the clue on the K1 that the allocation may not have been handled correctly?
Yeah, I would say most of the time managers are going to provide some sort of financial information.
Well, there's always some sort.
Well, you should have your financials, and it should show what the depreciation expense as funded.
Well, it should basically show your net income. And ideally, they've kind of got a wrapped up, reconciled set of financials, and you should be able to multiply that by about your capital percentage, and you should be getting that in box 2 of your K1. And if it's very different from there, I'd probably start with asking for a reconciliation of that difference. Because oftentimes, what comes to us gets adjusted by us and then goes on your K1. So there could be differences, like booking tax depreciation, or making some changes to your financial.
There's a 20% difference and your allocation is 80-20, then you want to talk to them about checking the allocation. Yeah. Right?
Sure. Yeah.
For an acquisition, if it happens in Q1 or Q4, doesn't matter, you still get first bonus depreciation.
Yeah.
So you can have acquisitions in Q4, and your your engineering company who's standing right there gets you. We're supposed to get it this week, right?
We're waiting on some answers from y'all.
Yeah.
Well, then you're going to get it this week. But you have the study can be done afterwards, as long as it's done before the K1 is due.
Yeah, it can be December 31st.
Yeah, we actually did one on December. We had somebody pay up front for their study on December 31st because he needed as many expenses as he possibly could jam into the last year as he could.
Charge him a lot.
Huh?
Charge him a lot.
Charge him money. It's just because he's going to have a lot more real estate there. I mean, and we're starting the process now, but he's not going to finish his taxes until probably September because of course, but he won all that expense that he couldn't in the last year.
If it's a Q1 acquisition, then in theory, are all the capital expenditures for the rest of the year qualify for Section 179 and bonus depreciation?
So on real estate's not really considered a trade or business, and so the assets are not subject to Section 179. Checking over here.
Yeah, that's right. But bonus, now that bonus is 100%, it really doesn't matter.
On all the CapEx?
You got to be careful.
Yeah, that's not everything. So back to our original example, we have building, land improvements, and furniture and fixtures. If you put in a new parking lot as a land improvement, yes, that would be. But if you are making CapEx expenditures for the building itself, those would they follow the breakouts that you would have on the cost side as well. So
unless they're 27.5 years or 39 years, they're 15 years or below.
They're eligible for bonus. Yes.
Yeah.
Anything that's 20 years
or less
would be eligible.
Except, well, the big caveat to that now is tenant improvements. That is something that used to be allowed for bonus, but part of the new tax law there was an error in it that has not been fixed that took that away for tenant improvements.
None of our tenants are improving anything.
Perfect.
Yeah, we call those repairs. So, how much time do we have? Do we want to? Well, I don't. This is your show.
No.
What?
My curiosity,
What, this?
Reading of the next one.
What's the next slide?
734. 163J.
Okay, we'll just we picked out two quick things from the tax bill that I think is meaningful to syndicators and managers and real estate folks. And so I'll try to move fast and not get too far in the weeds. But the first thing is 163J, and this is basically your interest expense limitation. And so basically you take earnings before interest and it's 30% of adjusted taxable income, which is that earnings before interest. And you can have your interest expense be limited. Now look, there is, if you look at the rules in there, it talks about having that you're not subject to this as long as your receipts or your revenues are less than $25 million. But if you really look into the rule, it's an aggregate of, your investors have to aggregate their receipts across very many investments and things like that. And there's a lot of complicated ways about calculating it. And so you might just be thinking that, hey, I only have less than $1 million of receipts. This doesn't come into play. But then there's also another rule in there that talks about syndication specifically being subject to this rule. And so, and when you look at the definition of a syndication, it basically says, what's the percentage? 75%?
35?
70% of losses allocated to limited partners, I think.
Which is pretty much every partnership ever, and we're all sitting there talking about how to generate losses through accelerated depreciation. So for all intents and purposes, all of your investments and partnerships are syndicates and they are subject to these rules, which means that if you have a highly leveraged property and you're paying a significant amount of interest, it probably should be limited or could be limited. And you may want to be checking your returns, making sure you're doing that right. There is one nice out to this, and it's in this line right here, which basically allows you to recalculate your depreciation under the ADS system, which is basically longer lives. For residential, your 27.5-year property goes to 30-year property. On legacy ones, it goes from 27.5 to 40, which is that's kind of rough. But really, if you think about just going from 27.5 to 30, that's not that big a deal. And it's only on real property. So like what Ben was talking about with land improvements and things like that, that's not really considered real property because it's technically not connected to the building. And so that stuff still gets bonus depreciation. And so from our perspective, we did a lot of research on this at the beginning of last year. We really felt like it was a no-brainer to go ahead and elect out and go with the ADS and just lose a little bit of depreciation. Because here's the thing, here's what happens is the interest expense limitation flows down to your partners, and on their 1040, that part is separately stated, and they basically, it's like a passive activity loss. It's like this new bucket of passive activity losses just for interest expense, and it just sits there, and it only gets unsuspended if you have enough income to unsuspend it, and then if you turn around and sell that property and that gain flows down, that interest expense just goes into your basis and basically reduces your capital gain. So you finally get benefit out of it, but it's at capital gain rates, as opposed to that interest expense always being an ordinary deduction at ordinary rates. And so you kind of cut your ankles off a little bit on there by not simply opting out and just going with ADS and losing just a little bit of depreciation in the name of maintaining better tax treatment in future years. So I know I flew through that on 163J. I missed anything on that?
I would just say that we did a lot of analysis for our clients on that, and by and large, almost every single one of them, when we looked at the numbers, were losing just a tiny bit of depreciation to get a ton of interest. So that's why it was a no-brainer most of the time to make that election.
And then let's go to one more slide, Luke. So this is the last thing we want to talk about, and so we presented this a similar kind of presentation about 6 months ago, and we kind of did this what did we know then kind of approach as the tax bill rolled out, and then kind of what do we know now kind of deal. And so the carried interest rules, I don't know if it really was on y'all's radar or not, but you guys talk about trying to drive losses as managers or not having your equity interest. But what happens when you go turn around and make a lot of money? Because technically the IRS looks at your manager position that doesn't have cash attached to it as a carried interest or a promoted interest or whatever you guys want to call it. Everybody uses a lot of different names. And what happens is it went from requiring just a 12-month holding period to a 3-year holding period. And so gains that would be allocated to you as a promoted interest would get reclassified from capital gains to ordinary, and all of a sudden, when you're looking at this thing on pro forma, and it's a less than 3-year hold. The economics of it just got flipped on its back because the tax consequences are not good. So that was kind of the initial thing, right? And then, but what we ended up doing is we spent a lot of time on this as well, trying to solve for it and figure it out. And without getting too far into the minutiae, there's basically two approaches. I think one approach is kind of out on an island, and I don't know if it's the best thing in the entire world, but basically the way it's written is quite clunky, and you can take this position that your holding period basically starts when you do any kind of business associated with that underlying asset. And so you can go ahead and start your LLC or document that you dreamed about it that night or whatever. Then boom, your clock is starting to tick. And you hope to get to a 3-year holding period in that partnership interest, and then you avoid it. That would be on the very aggressive spectrum. And as we were kind of rolling that out, you haven't really seen much support for that along the way. But there is another approach to it, and that is that if you look at the way the code is written, it basically says that long-term capital gains are reclassified to short-term capital gains. And if anybody has gone through kind of the business cycle of a real estate property and has sold it and made some good money on the real estate, and they look at their K1, they know, you may not know because you gotta be a dork like us to really know, but I believe it's line 10 is 1231 gain is where your gains are reported. And so 1231 gains typically get reclassified to long-term capital gains on your 1040, but they work under a different set of rules and a different, they are reported on a different form, and they operate in a different way. And my hope, I mean, our president is heavy into real estate, so I could see him selfishly making sure that there's like a little kind of something in there that makes him okay from a real estate gain perspective. Maybe it was intentional, maybe not. But in there it does say long-term capital gains, but your gains are 1231 gains. And so we really believe that's a really strong position to have these rules not be subject, to basically live underneath the old rules and not be subject to that 3-year change. And I will say on that, if you kind of Google that, you'll find a lot of people mirroring that thought. And there is a lot out there where people agree with that. And so that's not really, I think that is aggressive. If you go on to the next slide, what we know now, right? Like, no news is good news. The IRS really hasn't clarified much of anything. On a lot of pieces of the tax bills, they've come back out and said, give clarification on things all throughout the year, but they really haven't come back on this and really said anything specific to real estate. So we feel pretty good about that, and that should be a really good result for you as a real estate investor. So those are those two things. I know I went fast through that. I hope we've kept your attention. If there's any other questions, let me know. Anybody have any questions? Well, we appreciate y'all letting us come present to y'all. Where's Merrill? I don't know. Thank y'all so much.
Thank you.